Welcome to the Flow Tracy Money Audio Commentary. This is Owen Tracy recording, and it is 3:34 p.m. that is Central Time. Today is March 10th. I thought we'd kick off with the Fangman relative to the total market cap of the NYSE ratio, because it has been one of the most, emblematic ways of monitoring this massive bull market we've had over the last decade. And there have been very few times when it has traded below the 200-day moving average. Following a dip in 2013, it popped back above the moving average, and then it just kept going. And we've had a couple of instances when it did trade below it, and then it rebounded quite quickly. The big exception was the large decline we saw, particularly in the tech sector, in 2022, and of course because most of the largest cap companies are in the tech sector, then that was particularly difficult for this ratio. Now, with the advent of artificial intelligence and low valuations at the end of 2022, we had a big recovery, and that low in early 2023 at 0.16, and then the ratio went up to about 0.3. So it almost meant that 8 companies went up twice as fast as the rest of the market over the last 2 years. And now we've had a meaningful decline. So this is a dynamic move down through the 200-day moving average. It holds out the prospect that we're going to see a full reversion towards the 1,000-day moving average. Now, there's only been 2 occasions in this last decade when that has happened. So one was at the end of 2022, and that was a very attractive buying opportunity. And then in 2013, I think that we hadn't really got escape velocity just yet for a technology-led bull market. So I don't think that's quite the same. I think the big difference on this occasion is that valuations have gone up a lot. And now there are big questions being raised about the sustainability of the economic expansion and the impact that the effort to placate the bond market is having on the wider economy, as well as the potential for it to have an effect on corporate earnings. I think more than anything, that is the primary reason why we have underperformance here by the largest cap companies. So there's certainly plenty to think about in here today. Now, when we zoom out a little and just look at the NASDAQ 100,